Maverick. Noun, unusual person. A visionary, leader, go-getter, an independent thinker. They see the vision for their life and pull that future towards them with an unyielding belief that things can and must be better. They achieve what most won't. Innovative, influential, daring, and direct, with a remarkably high tolerance for taking calculated risk. A foe to the status quo. This is Passive Real Estate Investing with Mavericks. Your host, Neil Timmins, has been involved with over $300 million in real estate transactions. He's a published author, commercial property investor, and real estate syndicator. This show is for those who want to learn how to earn passive income through real estate investing. Now, here's your host, Neil Timmins.
On this episode of Passive Real Estate Investing with Mavericks, I sit down with Matt Picheny to uncover the Backstage Guide to Passive Investing.
Hey Mavericks, this is Ava Baukamp, and this episode of Passive Real Estate Investing with Mavericks is brought to you by Legacy Impact Investors. We are an industrial investment firm located in cash flow country, the Midwest. We strive to shield off risk and beat inflation, all while producing predictable cash flow. We curate real estate investment opportunities for busy professionals and other real estate investors seeking passive income. To learn more about what we do and connect with me, go to www.legacyimpactinvestors.com.
Welcome to Passive Real Estate Investing with Mavericks, where we provide you actionable steps to grow your passive income and become job optional. During this episode, you're going to get to discover a Backstage Guide to Passive Investing. Now, for those of you who are new, I'm your host, Neil Timmins. I love passive income. Now, before I introduce you to today's Maverick, I want to make a request that at any point, like what you hear, well, give us a thumbs up. Be certain to subscribe to the show. Never miss a valuable episode. If you love what you hear, give us a written review. Plus, be sure to look at the description of this episode. We packed it with thousands of dollars in free resources. Now, today, we've got the privilege to learn from a person who's invested in over 7,000 apartment units. Prior to his career in real estate, he was in the theater. Ultimately, it all changed when he took control of his financial freedom. I would describe today's Maverick as someone who's passionate about learning and continuing to learn how he can improve the investment returns for both his investors and then improve the communities that he's involved with. Today's Maverick, Matt Picheny, is here with me. Matt, how you doing?
I'm great. Glad to be a Maverick.
Well, you earned it, man. You cut your teeth. You've been doing this for some time, and I'm excited to unpack that for our conversation today, the audience who's here. So, hey, for those who do not know you, who are you? Where are you from? What do you do?
Yeah, so my name is Matt Picheny. I am a investor in real estate. I also mentor people who look to do that from an active perspective, and I live in Brooklyn, New York.
Take me back to the very beginning, the very first commercial deal you bought. What was it?
First commercial deal I bought was a 132 unit property in Lawrence, Kansas. Purchase price was a little under $10 million. Was
that student housing or not?
No. Good question, because Lawrence, Kansas is known for KU is there. Population of that town is around 100,000, and about 30 to 40,000 of the people who live there are affiliated with or students of the, or faculty of the university. But there's also other people there. There's a lot of other businesses there. Besides the local business, there's a Hallmark facility there and a couple other manufacturing type of companies in the area.
Tell me more about that deal. How'd you find it? How'd you fund it? When was it? And bring me full circle, or where are you at on it today?
Yeah, there's so much about that deal. I actually wrote a whole chapter in my book about it. Yeah. But it was a property that I found through a property management company in the area that I was looking at. They were reviewing deals with me when I was looking at deals. That when I get to a certain point when I'm reviewing a deal and about to make an offer, I review it with the property management company, and they managed this particular property, knew that the owners were going to sell it, and said, "Hey, Matt, we think this is a good opportunity for you." And then we went from there. So that was great. Bought the property, operated it for about a little over 2 years. Things went very well throughout the ownership period, and then we sold it and made a very nice return for our investors. And that was a couple of years ago that we sold it.
Talk to me about so bring me current. Tell me about your most recent deal.
Well, I have a current deal that I'm working on right now. And because it's a 506C, I'm allowed to discuss it. If it was a 506B, I really couldn't.
Sure.
But this deal I'm doing right now is a little unique for me because it's a new construction project that I'm working on in Canada. The most recent deal I did before that, we just closed on a couple of weeks ago, which was a 3-unit portfolio in Texas, with 2 of the properties being in Houston and 1 of them being in Austin.
Mm-hmm. What was the size of that one, the one in Texas?
671 units spread out across those 3 properties.
Yeah. How'd you find that?
Yeah. So we found that through a relationship that we had with the owner. Right now, in case someone's listening to this in the future, right, we're talking right now, we're towards the end of 2023, and we had this property in contract in May. I think it was May or June of this year that we put that in contract. We've been talking with negotiating this with the seller for quite some time prior to that, and he actually had the property on the market the year before. We were able to, so at this point in time, interest rates are very high. Interest rates on deals can go anywhere from, well, they're really close to 7% now to 8 or 9%, just depending on the type of debt that you're getting, the location, the leverage point, all of those things. We were able to assume the loan that the seller had. He had 10-year loan on it, and he was 3 years in. So he had 7 years left on his loan at a 3.8% interest rate.
Yeah.
So that made it a really very, very compelling opportunity for us to go in and bring on debt at such a low interest rate, especially given the way the market is right now. And the deals themselves also had a lot of value that could be added to them. So we are excited about that. Just took it over a couple of weeks ago. I was actually just down in Houston last week, overseeing the transition. Things are going very smoothly, and we're excited about the prospects on that.
Tell me, between the first one and the most recent one, I'm certain there have been a lot of things that you've learned along the way. What are the top 2 or 3 that stick out?
Oh, that's a good question. I've done, around almost 4,000 units in between the 2. Mm-hmm. I've my total overall assets that I've had under management, not including my passive investments, which I've had over 7,000 units that I've invested in passively, and I continue to invest passively, but around 4,500 units, a little over that. So, I mean, I've learned so much. I don't even know where to begin. Right. I teach in my book the 18 different keystone concepts that I learned along my journey. And so some of those things include things that are very, I think a little more, should we say, philosophical than nuts and bolts, but really, one of the keystone concepts is about how time is actually more valuable than money. Mm. You could always generate money, but you can't generate time.
Right.
So, and trying to find ways to have your money work for you without you having to trade your time for money is pretty compelling. And then there are nuts and bolts things that we talk about, how, you can really improve properties value by adding value, right? By going ahead and making improvements, by curing deferred maintenance. But also I think adding value for me goes beyond just that. I try to improve the properties that we invest in, and make life better for all of the residents who are at the property, and also the staff, and ultimately for the investors. I mean, it's not a charity. We're in this to make money. There's a profit motive here, but I think you can do well by doing good. So one of the things I'm looking to do is sort of reinvent property ownership as something that's positive for communities, instead of, people always get that landlords kind of have a bad reputation. Right. Yeah. It's like slumlords or things like that. And that's really not who we are, or what we do. the vast majority of us don't do things that way. And so, there's other things that I've learned in terms of, partnering with people and bringing in people who are smarter than you or have more experience than you is really important, right? So I always look for partners who know more than me. And so that extends to, other members of general partnership if I'm doing a deal, but goes beyond that in terms of the different teams that we bring in, and even when you're talking about bringing in specialized people, plumbers or electricians, especially while we're going through due diligence, like I know you need to scope a drain. I don't know how to do it. I don't know how to operate that camera. So to bring in professionals who know how to do that, I think is really important. Working with really great third-party property management that has a lot of experience and a lot of connections in the area is super important. So, building those teams, same thing with, when you're looking at legal or accounting, right? All of these different specialties, they're all really important aspects of the business. And so building a strong team of people who have a depth of experience is super, super important.
Talk to me about, there's a tremendous amount of, opportunities that exist out there, and you see more than your fair share. But what makes an opportunity a deal for you? What does it have to have? What's the general makeup of that?
Yeah, well, I mean, for me, I want it to be a win-win. That is a major thing for me. How can I make this a win-win? If I can make it a win-win, then I'm all in. Oh, that rhymes. I didn't ever thought of that before. But I'm being serious.
Tell me about how you make
Sure.
I'm talking in the nuts and bolts, a particular what lines it up there and can potentially make it that proverbial win-win.
Yeah. I mean, I want to see something where I'm going to be able to make improvements to a property, right? Some people buy real estate and just believe that it's going to go up, right? Because generally real estate appreciates like 3 to 4% over time, long-term average in the United States. But I don't subscribe to that. I mean, I hope that will continue forever. But all of my underwriting, I never account for the market appreciation. I'm looking at how can I force appreciation? What are the things that I can do? So that's something that's really important to me. It goes into making it a win-win.
Right.
Are there things that I can do to make this property? I want a property that is not really operating at its highest and best use. And what are the things that I can do to go ahead and do that? Now, a lot of times that's just a value add at varying levels. Sometimes it's a small little, minor adjustments to a property and tightening up the operation. Sometimes it's repositioning an entire property, or sometimes it's like my latest project, which is the ultimate value add, which is we're taking existing properties. We've assembled them together. We are now going to take down the existing structures and rebuild. That I see as the ultimate value add. But I want to see deals where I'm going to be able to underwrite in a conservative fashion, right? Not bank on market appreciation, but improving NOI and therefore the bottom line and therefore returns for investors simply by implementing a business plan that makes improvements, not hoping that the market goes up in value.
When you say you underwrite in a conservative fashion, what does that actually look like in the underwriting that would make that conservative?
I like to look at deals where I'm looking at historical data and using that historical data to underwrite. So, it's all fine and good right now for me where we are in 2003 in the market, and say, banking on a 3-year, refinancing year 3, you shouldn't do. But I wrote articles about that 2 years ago when everybody else was putting that in their underwriting, right? They were saying, we're going to refinance in 3 years, and interest rates right now are 3%, so we're going to underwrite a 4% interest rate when we refinance. And I was saying, guys, that's way too aggressive. And I've always done that. I never bake in refinances, and I look at historical data when it comes to things such as rent growth. When I'm looking at vacancy, I also look at the economic vacancy. A lot of people don't look at economic vacancy.
Sure.
Okay, physical vacancy, but you have to understand economic vacancy is going to include your loss to lease, your bad debt, any concessions that you may have now or need to implement in the future. And I've been doing that with all of my deals since the beginning. And it's allowed us during the boom times to be able to exit our deals in 2 to 3 years instead of 5 to 7 years that we underwrote. Now I think as we're getting into more normal times, we're still going to have that 5 to 7 year time horizon, which we've always underwritten for. I haven't had to change my underwriting drastically starting around the beginning of this year, end of last year. People started asking, I've been on, a number of podcasts and interviews and things of that nature. How are you changing your underwriting? How are you changing your approach now that interest rates are rising? And I say, I haven't changed anything really. I mean, I'm a little, the one thing that I have changed, if I'm being honest, that there is a little bit of a change because just when it comes to the financing that I'm putting in there, I'm underwriting different terms for the financing, not as much leverage, maybe higher interest rates, but that's not really like a change to my approach or my strategy at all.
Right.
It's just dealing with the reality that we have. But I've always been underwriting in a conservative manner, buying properties at, let's say, a 4 or a 5 cap and saying, okay, historically, the data is showing me this is a 6 cap market. So when we go to sell it, in 5 years, I'm underwriting it at a 6, even though I bought it at a 4, where other people were like, oh, well, it's 4 cap and I'm going to increase by 10 basis points per year. I don't know who came up with this idea, but someone came up with an idea that seems like a lot of people do. Oh, you increase your cap rate by 10 basis points a year. And I'm like, well, why? Maybe you don't need to increase it at all. Like, what is the historical norm in that area? If you're buying something at an 8 cap right now, and historically it's a 6 cap market, maybe you can underwrite it that you're going to sell it at a 6 cap because that's what it normally is. Maybe there's a reason why it's inflated right now. Sure. And for those who aren't familiar with cap rates, any of your listeners, the higher a cap rate, it actually means the value is lower. So it's kind of got that inverse relationship there.
When a passive investor is looking, to add an operator, what types of things should they be looking for in an operator? Maybe a different way to say it. What are the red flags and what should they latch onto as let's say green lights, if you will?
Yeah, I have a free download on my website. So I'll just pitch it real quick, picheny.com, right on that front page called Sizing Up a Syndication. That gives people, it's a subset of the actual full list that I have in my book that talks about the things that you'll want to ask a sponsor before you do it. And I'll share some of those things with you right now. So there's really, I look at a deal, I think there are 3 pillars to any deal. The first one is the person who's running the deal, right? The syndicator, the general partner, right? The sponsor who is in charge of the deal. That's the most important of the 3. The second one is the market where the property is located. And we're talking about the general market overall, but also drilling down to the submarket and the actual block that the properties are. And then number 3 is the deal itself. How is the deal structured? What is the plan? What is the strategy here, right? And so you got to look at all 3 things. When you're looking at the person, at the sponsor, some of the questions that you might want to ask yourself, number 1, how did you meet this person? If this person sent you some random spam or, contacted you through a LinkedIn message or Facebook Messenger, doesn't mean they're bad, but it's like, okay, who is this person? My spidey senses start tingling right away. I'd rather meet somebody through some sort of face-to-face interaction. And the best way to meet somebody, a potential sponsor, is through recommendation of another investor, right? If I'm talking with you, Neil, and Neil, you said, oh, I invested with so-and-so, and the deal did great. They were wonderful to work with. The communication was fantastic. Well, then that's someone that I want to meet and get to know. As I mentioned, I have over 7,000 units that I've invested in passively. About more than half of my portfolio are deals that I invest passively in. So I'm always looking to meet people who are good sponsors. Another thing you want to look at is what is their track record. Everybody starts off somewhere. So I'm not saying don't give a newbie a shot, but I would, if it's your first deal as a passive investor, maybe don't go with a newbie on your first one. And maybe take a look at the compensation model to see if it makes sense. I see a lot of people who want to do their first deal and want to take a 3% acquisition fee. And I'm like, okay, so you've never made a dime for anybody, and maybe themselves, but you haven't really taken an investor capital deal in. You don't have a track record, and you're going to walk away from this deal with $500,000 in your pocket. That doesn't really seem like our interests are aligned.
Sure.
Now, if it's someone who's done a bunch of deals and has a strong track record of, delivering and over delivering for their investors in the past, well, then maybe they've earned that acquisition fee. But off the top, it's kind of a hard pill to swallow. So, I want to look at the track record. I want to look at the sponsorship compensation to make sure it's commensurate with their experience and the work they're going to be doing on the deal. Those are some of the things that I look at.
You mentioned communication, and certainly, you've seen a lot of communication, and you participate in a lot of communication with your own, GP, everything you own directly and raise money for it. But then also as a passive investor sitting on the other side, being communicated with as a passive investor. Tell me, from your standpoint, what do you do? What do you love that a GP has done that maybe you implemented into your own practice?
Oh, I don't know that I could pick just one thing. Sure. I'll tell you that when I first got involved in this business, I started investing passively, and I invested passively in 7 deals before I was general partner in my first deal. And each of those deals I invested in with different operators. So I could see how they were operating their business, see what the communication was, and take the best. So, my reporting and my communication with my investors is, a Frankenstein, if you will, of what I thought was best in class and other things that I've learned just throughout my career. And I had a whole career in business before I got involved in the syndication business. So, I send out monthly reports. I like to give a summary in prose up at the beginning of the email to talk about sort of where the project is, how it's coming along, what the operations are looking like. I then pull out some important KPIs. So those are key performance indicators of how the property is performing. And I pull those out right into the email. So I'll talk about sort of our income versus the budgeted, right? Sometimes people just tell you the income and you're like, okay, was that good or bad? So I'll show income versus what our budgeted amount was and the variance for that. So a little chart that I put together. And so income, expenses, and NOI, right? The net operating income versus budgeted for the month. I'll go through a couple other ones such as, occupancy, move-ins, move-outs, those kinds of things. And then I have another chart that I put at the bottom, which is a 12-month look. So obviously it builds over time, but once we get to once we've been in a deal for 12 months, it's a rolling 12 month. It's actually a rolling 13 months because I want people to see where we were in, if it's June of 2023, I want them to be able to see June of 2022 performance. And it's a bar chart and lines, and it's displaying income, expenses, and NOI projected versus the actuals. Yep. And you can see how we're trending. And it's a really great snapshot where you can go ahead and take a look at it. And then right underneath that, there's a link to download the full financial package. So the full financial package is going to include in it your T12, right? Your trailing 12 months of profit and loss. Yep. It's going to have a cash flow statement. It's going to have the balance sheet. It's going to have the rent roll. And a budget versus variance report. Those 5 reports all combined into one PDF. So for anyone who wants to get into the minutia, they can. It's there. We're completely transparent. For 99% of the people, all the information they're going to want is right there in the body of the email. I like that. I hate when I get these reports from sponsors and deals that I'm in, and it's one line, and then I have to click and download this big bulky attachment and open the attachment and start scrolling. Like I just like, what was it? Dragnet, I think, just the facts, ma'am, right?
Yeah.
Right.
Yep.
I like, give me the details right there in the body of the email. Give me the key points, the executive summary. What are the things that I need to know? And then if I want to drill down, I can drill down. Yeah. So that's what I try to do. Summarize it so people can understand it very quickly. But then if they want to get the detail, it's very transparent. It's all right there.
What are you most excited about this year?
The end of this year or early next year?
Yeah, I mean, yeah, you tell me. In the next, maybe, how about this? I'll ask you a different one. In the next year, looking forward, what are you most excited about? Yeah.
I'm very excited about the project that we're working on, the new construction. This is my first as a general partner. I've been a limited partner in a number of them, at varying levels of involvement. I have a good friend and business partner who is an architect in Boston, and he did a new construction project, like all the way from the beginning. We optioned the land, and then we did the entitlements and the whole 9 yards. And so I was able to learn a lot from all of those experiences. So now I'm taking all of those experiences together onto this project. So that's very exciting for me. And I'm just curious to sort of see how things go. I mentioned earlier that I do have a coaching program where I teach people how to do this. And a lot of my students are starting to get a lot of traction recently on a lot of deals that they've been underwriting. Some have been awarded deals. Others are very, very close to being awarded deals, and that could happen any day now. So that's very exciting, right? To see other people succeed, and I'm trying to help them. I think that the whole market as a whole is starting to open up a little bit. I think sellers' expectations are starting to, not fully there, but starting to get in line with where they need to be for deals to make sense. Sure. So, it's been 18 months or so, roughly 18 months, where it's been hard to have a deal pencil out unless you're able to do something like a loan assumption. But I think that we're about to sort of cross to a point where maybe some of those things become interesting. The other thing is I'm interested to see when the Fed decides to stop raising the interest rates, because I think we're probably getting close to that. We'll see how the economic data goes. I have no crystal ball, but we're probably getting to that point. And when we do get to that point, I think it'll be good for multifamily overall, because the financing will start to stabilize. We're not really in a real estate crisis right now. We're not a real problem with the real estate, but we do have a liquidity crisis, and we're having a lot of problems financing these deals right now. And anyone who's got to refinance right now is up, between a rock and a hard place in a lot of cases. So I think seeing how that plays out over the next, let's say, 12 months is going to be interesting, because I do think that within the next 12 months, we're probably going to see a pause in the rate hikes. Hopefully that'll be an eventual stop. And then maybe rates come down a little bit. I'm not expecting them to go back down to 3%. It'd be amazing if they do. Yeah. But I just think that pause will just give a lot of certainty to the market.
Yeah. Let's do this. I want to move on to the final segment, what I call the final four. What do you think holds most passive investors back from hitting their personal next level, whatever that happens to be?
Fear. And I think it would all boil down to fear of the unknown, but I think it all boils down to fear ultimately.
Outside of real estate, what are you passionate about?
Theater.
I
have a theater background. I actually won 2 Tony Awards as a co-producer with my wife on a couple of Broadway shows. We see stuff all the time. I'm a big passionate fan of theater and art in general. Yeah.
Your favorite book?
Oh, besides Backstage Guide to Real Estate, my book, favorite book, that's such a hard thing to say. Right now, I'm listening. Actually, I've started doing listening as I walk around the city to a book that's pretty good. It's called Ready, Fire, Aim. Mm-hmm. And I'm finding it really interesting. I'm only a couple chapters in, but it's really good.
Your favorite way to make an impact in the community?
Making improvements.
Yeah.
Yeah.
Matt, this is a terrific conversation. You are a world of experience and I'm certain stories. I appreciate you taking the time out of the schedule to connect up here. For people, they want to find you, they want to follow you, they want to connect with you. Where can they go? What should they do?
Yeah, you should go to Picheny.com, and I'll spell that. It's P like in Peter, ICHENY.com. I'm sure you'll put that in the show notes, but on there you can check out, it's got links to all of my stuff. I have a lot of free resources there, downloads, videos. I've got links to the stuff on the YouTube channel there. I just put out a ton of educational content for free. So go check out Picheny.com.
Links below in the show notes. Matt, thanks so much for the time.
Thanks.
To our listeners, pat yourself on the back. You guys have made it to the end of the show, and most people never finish what they start. If you receive value from today's show, be sure to share it on LinkedIn, your Facebook page, or your social media platform of choice. Subscribe to never miss a valuable episode in the future. And if you found value in today's episode, give us a thumbs up with a positive review. If there's a particular topic you'd like to hear about, well, I want to hear from you. Shoot me a message on LinkedIn. The link to my profile is below in the show notes. You can connect with me there for more valuable content.